Hello everyone, welcome to another YouTube video. And in this one, we're going to be talking about short-term trading like a pro. Okay, so we're going to be looking at S&P divergence and my doubling theory times X rather, power of 3 application. Okay, so whenever we are considering about short-term trading, we're actually thinking about long trades. So we are actually sacrificing frequency of trades for basically catching a large haul. Okay. Now, what is short term? So, like I said, frequency sacrificed for large hauls. Yeah. So, short term trading is an approach to trading unlike day trading. So, in day trading, we just want to capture the at least some portion of the daily range. Okay. So, when we consider short term trading, we're actually capitalizing on larger moves, right? Based on fundamentals, looking for the liquidation of larger opposing liquidity pools, as we will talk about later on in this video. Okay, so short-term trading is something akin to trades taken by hedge funds, because as we all know, hedge funds don't really deal with day-to-day, what you call day-to-day trading like how we do. Liquidity rate buy, liquidity rate sell, fair value gap buy, fair value gap sell. Hedge funds don't really do this. Okay, but some hedge funds do, and these are the hedge funds that utilize high-frequency trading algorithms, and also sometimes their manual algorithms as well. Okay, there are manual algorithms as well, but not every one of them. Okay, the secret to success when it comes to trading, I would say, is not in day trading, but it is actually in short-term to swing trading. So what is my short-term trading formula? As you will see later on in this video, we are looking at the COT report, the commitment of traders report, daily plus liquidity pool. So that means when I say plus, I mean the weekly time frame, monthly time frame as well. S&P divergence on the 1 hour chart, plus past failure swings, and also the Wednesday breakout, which is part of my fractal framework. Right. So when looking at the commitment of traders report, yeah, we are looking at both the commercial and non-commercial. They are the main participants, in fact, in the commitment of traders report. So the commercial participants are those that have an actual use of the assets being traded. Yeah. They take the actual deliverables as they require it in their day-to-day business practices. So commercials, for example, if they deal with gold, yeah, they will actually take that physical gold asset because they have a use for it. Let's take jewelry companies, for example, jewelry companies that produce a gold jewelry. So if they do take part in the futures market for gold, they will actually have a stake in the actual gold asset. They will get that gold asset on the expiry date. Okay, so that's the main difference between commercials and non-commercials. So non-commercials, they are the participants, yeah, such as large funds that are looking to make speculative profits. So they just like how we look to buy and sell, they are also looking to buy and sell and make a profit in the difference in price. Okay, so it is important to note that the commercials, they're doing what they do as they are the experts when it comes to the assets that they have positions in. So it's very important to note what they are doing. Okay, this is their lifeblood in terms of goods and services in their business transactions, right? So whatever the commercials are doing, when you look at the commitment of traders, that is very important to see. It's very important to note. So by understanding the commitment of traders report, we are actually able to internalize long-term fundamental market direction, as the report itself is an X-ray view into what large market participants are doing. So I hope you really understood that, because that will be very important when it comes to you deriving a fundamental bias. Okay, so if you take a look at this example, yeah, you can see the non-commercials in this case as of the 3rd of as of the 12th of March 2024, you can see that the non-commercials 6.5% are long, whereas 43.1% of them are short. They hold short positions. If you look at the commercials 11.9% are long, while 36.0%, yeah, are short. They hold short positions. Okay. Now, in terms of the change over here, you can see that non-commercials actually closed a lot of shorts. So when they are closing a lot of shorts, inversely, they're opening the same amount of longs. So the non-commercials are net long in their positions. All right. And if you look at the commercials have actually closed 2,456 long positions on the dollar index, basically on the dollar, right? So that is equivalent to opening 2,456 short contracts on the other side. Okay. So if you consider who is winning, right? If you consider who is winning, we can say right now the non-commercials are winning. But why are they winning? Because if you look at the change in the open interest, the non-commercials have opened up more longs than the commercials have closed longs. And at the same time, if you look at the number of traders in each category, yeah, we can see that non-commercials have a lot more traders than the commercials. So right now, the non-commercials are running price. Okay, right now the non-commercials are running price in the dollar, which is why you will see that this week the dollar has been rallying because of this. Okay, because of this. So when there is a change, if you can see, check this right here. Yeah, remember I said we need to really take note of what the commercials are doing. So if the commercials are closing up their long positions, basically adding into their short positions, it is telling us to be careful. Meaning it's telling us that, okay, the moment the dollar index takes out a significant buy side liquidity pool, we should get ready to go short on the dollar and long everything else, which I will show you guys as we approach the end of this video, or rather this presentation when we go into a live chart and I show this to you guys. So stay tuned for that. If you are not staying tuned for it, if you are finding it boring so far, I'm sorry, you are not going to make it. Which is why you have gone through so many YouTube videos, you've come across my YouTube video and you're finding it boring, then you're going to go to another YouTube video and another one, you're going to fail. I'm sorry, I'm really sorry to say that you're going to fail. Okay, so sit your ass down, watch this, listen, take notes, and apply. Daily plus liquidity pools. So daily liquidity pools, right? They have a great degree of significance in terms of rates on liquidity. Okay, so any swing point that is printed as a daily high or a daily low, it has billions, if not trillions of dollars sitting behind them in terms of available stops. So what are available stops? Liquidity. Okay, it's a pool of liquidity above daily highs and daily lows, if you're looking at it correctly. Now, as a result, when price forms an SMT divergence against these liquidity pools, it's important to note that this could mean something big for overall price delivery. Okay? For example, if we are fundamentally bullish, if the hot report is saying that we're going to go up, then a bullish SMT divergence is classified as a manipulation. And this will then allow us to make price phase predictions as follows. You get the manipulation, you get the distribution, distribution 1, distribution 2, distribution. So as you all know, distribution 1 is a parallel to accumulation. Distribution 2 is also a parallel to manipulation. Okay, so if you have read my ebook, you would know this. Again, link is down in the description below. And you will see an example as we move towards the end of this presentation. Here you go. We have the 1 hour chart on gold. This over here, down right here, that's your dollar index. It's inverted because that makes things easy. It makes life easy. And you can see how the dollar index takes out previous day lows while gold does not. Okay, the dollar index takes out previous day's lows while gold does not. That's your SMT. So when price starts to move up above the 50% of this range, that's telling us that this is the manipulation. Then we can anticipate a distribution, another distribution, final distribution for that model, followed by a last distribution for the parallel AMD cycle that's running in distribution 1 and distribution 2. I know that was a mouthful, so pause the video right here, take a look at this, understand this, and then continue. Okay? Right. Now, when we have SMT divergence, we have a correlated asset class that actually gives us a failure rate. Okay. Now, just like how each trading session requires some measure of liquidity before moving, so does every single trading day. Okay. So in the case of a daily candle, it must take out daily liquidity. And so failure to take out daily liquidity, usually due to SMT, will lead to what we call a failure swing, right? So in this case, this particular day is a day that did not take opposing liquidity prior to moving. Meaning to say that this particular day that caused a failure swing is the day that did not take opposing liquidity. Therefore, it will become a target for guaranteed liquidation in the future. That low is not protected. It is only protected for the time being until that buy program or sell program is over. Here's an example. So here on NASDAQ, you can see this is fairly swing. Why? Because look, the previous day's low is somewhere here. So there must be an SMT over here that caused this run up. Okay. And here, this did not take an old daily low. Why? Because this is the old daily low. And prices goes up because there must be SMT. Okay. Then where else? Let's see here. Here. This is the daily high, right? Did price take out this side? No, there must have been an SMT over here. Going down, causing that to be a failure swing. And when we shift up, that's a guaranteed target. Now, as we are going up, this over here is an old daily low. We did not take out this daily low. So that's an SMT divergence with the other asset classes, with the other indices, causing a price move up to take out this failure swing right here. But why not this one? Because this one took out this daily high, causing an SMT divergence to go down. Okay, so yes, you can take a sell somewhere here. Yes, you can enjoy this entire move down, and then you can get caught to this massive retracement. Okay, so when that happens, simply put, you're obviously going to be taking partial, at least over here. Okay, at least over there, you're going to be taking partial. You're not going to, like a fool, you're not going to hold the entire position all the way down because partials pay 100%. All right, take that out. This is protected for now. This causes this to be a stacked liquidity pool. So once we finish this sell program, taking this one out, taking this one out, and taking this one out, and when we start to go up, we understand that price is not just going to go for any one of these failure swings over here. It will ultimately go out for this high. Why? Because that is a stacked buy-side liquidity pool. It will not remain. Okay, it will not remain. And finally, we'll take a look at my Wednesday breakout for technical buyers, right? So Wednesdays, as you know, are the midpoint of every week. So breaking out of the Wednesday range is very important in terms of bias, as this will tend to be the make or break moment for the entire week's direction. Breaking above Wednesday's range will spell a bullish week for the entirety of the next week until a Wednesday range is broken in the opposite direction. And of course, vice versa for the opposite scenario. And unfortunately, I cannot give out more information on this as it's only available in my one-on-one mentorship. So you can sign up down in the description below if you are interested in the one-on-one mentorship. Again, if you are interested. If you are not, please shut your ass up and move on. All right, I don't need you in the comment section spewing out bullshit. All right, so look at this example. Here, the shaded regions are Wednesdays. Here we break out on Wednesday, start going up, 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 up. Here, Wednesday again, break up, going up, 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 up. And this is this Wednesday right here. Price broke up, dragged back down for liquidity, went back up, came back down. There was supposed to be a bullish run from here due to the Michigan consumer sentiment news driver, which did not do anything, unfortunately. So maybe we'll be seeing something next week in price for this Wednesday's range. So far, nothing has changed. So let's see what it does. Now, let's put it all together and let's go to a live chart. All right. So let me just find my thingy here. All right. Now over here, this is Bitcoin. Okay, as you can see, we're in a position right here. This is demo. Okay. On Bitcoin, if I take you to the 1 hour chart and apply the same thing that I've been applying in theory, all right, let's divide the days up 6 o'clock to 6 o'clock and find a Wednesday. So this right here, this here, that's a Wednesday. Okay. So what we'll do is we'll take this closing price up to this closing price. Now you can see that price broke out above this Wednesday's range there. giving us a bullish bias. Okay, giving us a bullish bias. Now, because we are hitting all-time highs, we don't really have a reference point on the left. Okay, so what we can do is we can use my what 10-30 projections, right? So here it is. Take this, drag it down. One standard deviation, two standard deviation would be the target. Okay, so we hit 1 and 1.5, yet to hit 2. All right, so we'll let that be. Check this here. So our bias is bullish. Now, with this bullish bias, right, over here, if you want to take any trades over here, I want to see an SMT divergence with Ethereum. Okay, let's check out Ethereum here, down here. This is a low, daily low. This is a daily low, right? Can you see how they're all symmetric right now? They're symmetric, 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 until we have what? This one here. See, this one we have a low and this is a lower low. So both are lower lows. So is that an SMT divergence? No. So can we do anything as of yet? No. Right? Yes, you can take intraday trade. The bias can be bullish. You can take the intraday trade, sure. But for this to be a nice short-term trade, it's not correct as of yet. Okay. So look at this here. Now it's symmetric, 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 symmetric until where? See this low right here. And see this low right here. Can you see how they formed an SMT divergence? But listen, okay. This, right? This, does it count? Of course it can count. You can take a long over here and you can get stopped out. That's no issue. I mean, you are going to face one, maybe a loss or two. So in this case, if you take a buy right here, right there, it's going to be a loss. That's okay, right? Because then when price starts to drop even further and drops like this, see that it drops here, it forms an SMT divergence here. See that? This daily low remains intact, while the Ethereum daily low is not intact. Yeah, it's not intact. There's SMT divergence. And when price trades into the 50% of this dealing range or any fractal dealing range inside here, then you can go long inside of a fair value gap. All right. And what can you do then over here in order to capitalize on longs? Well, I mean, targeting for longs. Look how this one single pass through close above this high and this high. So you will take this high to this low and you'll target one standard deviation, two standard deviation. And then you will see that, okay, fine. I mean, we went all the way up and then we started dropping. Yeah, that's because we probably have something else to contend with right here, which is why this doesn't really matter. So it all depends on your analysis. Okay, and to keep it as objective as possible, okay, to keep it as objective as possible, of course, you're going to refer to the initial run-on stops over here, and that is going to be your reference point for deviations. Okay, followed by, so you see that we were going long over here, right? Long. Once we hit this Wednesday's range here, can you see this? See this? Take this closing price and this closing price up here. See how we broke up and then we broke down. Okay, we broke down. So the bias is bearish until another Wednesday goes bullish. All right. We are selling. Do we have SMT divergence at the highs? Yes, right? See, Ethereum makes a lower high while Bitcoin makes a higher high. So yes, we do. We do have SMT divergence. But how am I going to capitalize on more sells? Well, I want another SMT divergence. You know what I'm saying? I want price to take out a daily high and then go down. So in this case, this is the reason I'm going for one more long, because honestly, if price take out a high, it won't go up over here. Maybe it will go up towards the end of the day, and tomorrow it will take out today's high and then continue with the down. Okay, that is how we read price, and that is how we read price with time as well. Okay, and over here, I gave a freebie to the Telegram group. We are having a bullish bias for the New York session, so this is why I'm long as well. Over here, we have SMT divergence with the Asian low right there. That Asian low. We can see that Bitcoin took out the Asian low. Ethereum also took out the Asian low right here. Right here, it took out the Asian low. So what am I actually having an SMT with? Yeah, I'm having it with this low here and this low here. See that? This low here and that low over here. That's an SMT divergence. Okay. And then I have an additional SMT divergence here, low to a higher low, low to a higher low, low to a lower low. That's my SMT divergence. So can I really expect price to really smash all the way up? Yes, I can. Why? Because the London session is not responsible for anything, and the Asian session is also not responsible for anything. So this is moving way too slow. So I don't think it will work out. But I will give you guys an update in the Telegram group if it does. With that said, I hope you found this insightful. Good luck and good trading. Bye bye.